Hey guys, thank you all for clicking on this video. Today we're gonna address the elephant in the room. What will happen to Palantir stock when the lockup period expires? So this is how it goes. We're gonna start by explaining what the direct listing setup is. Then we're gonna focus on what typically happens to firms when the lockup period expires. Then I'm gonna tell you my thoughts on how I believe that Palantir stock might react to the lockup period. First, we have to clear up how Palantir launched into the public markets. Contrary to many beliefs, Palantir didn't do an initial public offering, but a direct listing. An IPO usually works when new shares of the company are created and are underwritten by an intermediary. The underwriter works closely with the company through the IPO process, including deciding the initial offer price of the shares. They also help with the regulatory requirements and buy the shares from the firm and sells them to its investors through its distribution network. This means that Wall Street gets involved. It does a lot of money when the stock is listed on the exchange. However, direct listings work differently. The business sells shares directly to the public without the need of an intermediary. It does not need any underwriter or intermediary and does not issue any new shares. Simply put, owners sell directly to the public without the need of Wall Street. Now let's focus on the pros of a direct listing, starting with greater liquidity to stockholders, equal access to all buyers and sellers, there's a greater transparency, and there's no dilution in existing stockholders. Another advantage is that there's no lockup restrictions, there's a reduced documentation compared to the IPO process, there's no need to review by the financial industry of regulatory authority, and most importantly, the cost of capital is cheaper in subsequent offerings. Now, moving on with the cons of the direct listing, there's no ability of the company to set a price per share, so the opening of the stock price is going to be determined by the market demand. There's less control over investors buying shares. No additional capital is raised by the company. And since there is no traditional IPO roadshow, most analysts have to discover Palantir by themselves. They might end up paying more advisors than would have in the standard IPO underwriting fees. They might potentially miss out the participation of larger investors. Financial advisors do not plan and participate in investors' meetings. When looking up at an IPO, we have to keep in mind there is typically a lockup period of 180 days in order to help the market establish a track record. Since we got a good idea about an IPO and a direct listing differences and commonalities, we can notice that PLTR is not like other direct listings but more like an IPO. That's why comparing PLTR with other firms that went public with a direct listing, it's just not feasible and irrational from our part, since firms like Spot and Work didn't have a lockup period for their employees. Thus, PLTR's price action is uncomparable to firms with no lockup periods. Another critical point that I should highlight is that the lockup period was put in place to control the shares float, so institutional investors cannot get in without driving the prices up. Therefore, large funds wait until the lockup period is over, hence creating a balance in forces between institutional investors that want to buy a large position and the shareholders that were restrained by the lockup period. Something to also keep in mind that most retail investors don't know is that although the company is 17 years old, its employees had the chance to sell their shares through back channels like the equities and offered to buy shares from the employees. Meaning that if Palantir's employees wanted cash instead of the company's shares, the liquidation opportunity is most importantly a backdoor that acts more like a price volatility stabilizer by losing weak hands of cash-poor employees. Putting everything into perspective, we can predict that a flood of new shares might come into the market if the owners decide to take profits. However, many shareholders like myself will retain shares either way in the hope of larger return. It is not unusual to see the stock price fall the day of the lockup or a couple of days prior. in theory, traders can start to play with dips perhaps 7 to 10 days before. Just remember, long-term investors who are bullish are probably going to see some dips, but then a lift back to similar prices. The larger picture and the reason I am doing this video, you should not worry about Palantir as long as it keeps growing like a weed. Small dips can be opportunities to buy more. Let's not forget that while insiders keep on selling their positions and putting downward pressure on the stock, remember that hedge funds and institutional investors are buying and loading up. Very important thing to note is that today, with a price of under $30, if the price hits $40 to $50 before the lockup period ends, it might drop to $45, $40 or even $25. In other words, the future dip can still be above the current price. Thank you guys for all watching this video. I just want to remind you that I'm not a financial advisor. You just have to see this video as entertainment, and I'm just telling you my personal story and investing journey. Please be safe.